That was the Finance Minister of Saudi Arabia, Mohammed Al Jadaan, speaking with our reporter on the trip in the States. Let's bring in our guest now. It is Dino Crumfall, CIO at Franklin Templeton. So, Dino, listen to that. The Minister,
good morning.
Keen to get right the way across the curve. He's considering everything. I looked at some of the numbers. Yusuf and I were looking at this morning. Saudi Arabia needs to borrow 31 billion. They've got a deficit of 52 billion. How would you, I suppose, describe that level of borrowing?
I think it's going to be very, very easy for them to be able to achieve that target. We have to remember that it's not just the number; it's also how we've kind of gotten here, the trajectory, and that's been generally speaking improving. I mean, the last 2 years they've achieved more than 20% of fiscal consolidation. It's pretty impressive what they've been able to do, and I think we need to keep that in mind. I think at these levels, this is actually fairly sustainable. I mean, 5 to 6, 7% deficits for a country that has over 100% in reserves, 100% of GDP in reserves, in my mind, is something that is quite sustainable.
We've talked quite a bit about geopolitical risk and how that affects Saudi paper. Now we've got two big events. We've got the event around Prince Al-Walid bin Talal coming on Bloomberg television and telling the story about reconciliation with the Crown Prince. And then you've got the high-level delegation in the United States striking deals with the United States, re-cementing that alliance. Does that change your view on Saudi bonds? Could that be a factor because it's reduced political risk?
No, I don't think it does, in fact, reduce the geopolitical risk or the tensions in the region. I mean, that remains, to a large part, quite uncertain, and I think is the source of quite a bit of anxiety for the region. However, I also feel that the bond markets, generally speaking, price in that risk, and I still find that the region offers quite a bit of value compared to other emerging markets. But I wouldn't take the events of the past few days or what you were describing as having significantly reduced the geopolitical risk.
Where are we in terms of pricing the bond market? You heard the Finance Minister talking about oil prices. Let's just have a look at this. We put it together for you, 72, 73. This is growth and oil. This is the challenge for the Finance Minister. It's also the challenge for the bond market as well. He says, look, my issuance is not correlated to my oil price. I really struggle to sort of take that on board. When you look at this kind of trajectory, we're almost going to move back into growth mode. What's that going to do to the bond market down here?
So, I know it's counterintuitive, but in fact, the minister is very correct. I mean, when you have the amount of reserves that they have, not only is his policy sort of unrelated or immediately correlated to oil prices, but also the bond market, in fact, is not correlated to the oil price. And that, holds over many years, not just now, because it just takes a lot of time for an oil price change to trigger a policy response and then transmit to the economy. So if you just allow me a second, it's important for your readers to understand that the way the oil prices go and the fact that they are very volatile does not mean that the bond markets are equally volatile. Bond markets are actually, in fact, less volatile than most other fixed income sectors.
I want to get your view on oil because we had a big move in the last 24 hours, and this was off the back of data from the United States. We put this up on a chart now. Our clients can pull this up on their Bloomberg quite easily at Jeep space hashtag BTV space 9715. Again, climbing to the highest level in 6 weeks after crude inventories in the United States dropped for the first time in a month, catching traders completely off guard. The 5-year average for the first time down than the average since first time since 2014. Where does oil go from here? What are you pricing in? What kind of range?
We're estimating that oil kind of remains in that $55 to $75 band. We don't think we're going to have a much bigger spike. But to your point, I think, yes, the physical market seems to be kind of coming to a little bit of an equilibrium. But I think with the oil market, we have to all be cognizant that, what happens in the physical market doesn't always necessarily need to be reflected in the futures market because, people forget, but the futures market is, 40 times larger than what actually kind of gets on ships and trades physically. And that can be motivated by different factors. And so if investors want to take positions, want to speculate on the direction of oil prices or the dollar or interest rates, that all can play out in the futures market, whereas the physical market seems to me to be moving in the right direction. I think we have to be cognizant that capex has been reduced significantly over the past couple of years. The trend should be that it goes up, but gradually, not dramatically.
There's nothing more annoying than those pesky speculators. You stay with us. We've got a little
Depends what side of the trade you're on.
It does indeed. Whether you're one of those fundamental asset management involved in long-term investment,
or a hardcore speculator,
or just a trashy speculator. I'm much